Hi, I'm Ian Irvine from ASX, and joining me here today at Bell Direct is Richard Murphy, CEO of XTBs, and we're going to be talking corporate bonds and where they fit into portfolios for investors and self-managed super fund trustees. Thank you for joining us today, Richard.
Thanks, Ian.
Richard, if I could just start out by perhaps casting a scene in that some of the things we see with direct investors and trustees of super funds is they are exposed to Australian equities in a long way, as well as holding a lot of cash and term deposits. And sometimes we speak to them about the need to diversify between the two. So where do corporate bonds fit in terms of maybe taking them a little bit further up that yield curve or getting a better return than they're getting from their term deposits?
Well, using where you said shares here at one end of a barbell and cash at the other, corporate bonds sit just above cash in a term deposit. So if you looked at that in risk-return terms, equities are obviously more risky. You get more return if things go well. And cash is cash, and term deposits yield 2 to 3%. Corporate bonds sit just above those, so they're a little bit more risky for a bit more return. So you're lending money to Woolworths instead of lending it to the bank, and really it's just a loan that's traded on the XTB version is traded on the exchange. So they don't give you the same returns as equities if equities go well, but they then don't have the same volatility, and that's obviously very important because people keep money in cash because they want low volatile returns and capital preservation, which is obviously critical.
So how are they similar to or different from a term deposit in terms of the structure and the outcomes?
So they're obviously not a bank account. Term deposits are bank accounts, and term deposits are guaranteed up to $250,000 per institution. So they don't have that feature. Corporate bonds and XTBs over them are traded on markets. So XTBs are traded on the ASX. And so you can buy and sell on a daily basis a corporate bond or an XTB over a corporate bond, whereas you can't buy and sell a term deposit. You have to break a term deposit. But beyond that, they're very similar in terms of payment structure. So with both of them, you put in $100, you get $100 bucks back on a known date, and you get interest along the way. So that sort of payment structure similarity and the very low volatility. Cash is obviously zero volatility, unless the bank fell over, whereas bonds have got fixed rate bonds have got 2 to 3% volatility, and floating rate have got 0.2% volatility.
Okay, so what I recall when I first adventured into corporate bonds is that you need a lot of money. So if I was an investor, typically it would be $500,000. Is that right, to invest in a corporate bond?
Yeah, the minimum transaction normally in the wholesale market is $500,000, and that was part of the reason for initiating XTBs, was to say, well, that's obviously too much for most people.
Sure.
Break it down. So XTBs, basically there is a bond sitting in the trust at $500,000 licks, but the XTB is available in $100 unit sizes on the ASX.
Right.
So you can spend a couple of $1,000s on XTBs without having to go to the full Monty of $500,000 per bond.
Right. So that's the first, or that's one of the key benefits it's made more accessible to retail investors because of the smaller chunks that they can use to invest.
Yeah, and then after that, you still get the same coupon rather. So the bond pays a coupon, and the coupon is paid through to the trust, and the trust then just pays it out to whoever owns XTBs. So once you own the XTB, you get all of the coupon. Once the bond matures, the principal comes back into the trust, and then the XTB holders get the principal as well.
So there's no uncertainty around I'm going to be paid so much on certain dates through the course of the life of the bond, and then at the maturity of the bond, then I get that $100. Is it face value? Is that the term?
Yeah, the $100 face value, exactly. Okay. So there is uncertainty in everything in life. The uncertainty is, will Woolworths, will Lendlease, will BHP be around to repay their debts? So that's the real risk you're taking, is the credit risk, the risk that one of those top 100 companies is not going to repay you. But if you accept that, no, they are contractually bound. You must pay those coupons, you must pay the final principal, and if you don't, the company's going into receivership.
So, heaven forbid, and it won't happen, but if one of those entities that you mentioned does have a problem, and you're a shareholder, you're likely not to get any money back as well. So you mentioned where the corporate bond ranks in the capital structure of the company. If you're ranking above shareholders, would you be paid first from any residual amounts that were available before the equity holders?
The average payout ratio of investment grade, these are the top companies, their bonds, when they do go into default, and we haven't had any defaults in Australia in a long time, Babcock & Brown, Pasminco are the only two in the last 30 years at investment grade level. But when they do go into default, the average globally is about 70% payout. So those senior bondholders are getting a lower return because they've taken lower risk, because they get the first bite of whatever is left over if the company does go into receivership or administration. And that's why shareholders usually get nothing when this happens, is that the bondholders have taken, they have to be paid out, and the average is about 70%, 70 cents in the dollar.
Okay, interesting. The other feature you mentioned is lack of volatility. In other words, unlike the equity markets that can be quite volatile at times,
Yep.
the bonds tend to trade a little bit less so. Is that the way?
Yes. Equities, if you look back to the year 2000, equities have had about 15, 16% volatility annually. And you actually want that because you want your shares to be going up. You want volatility on the upside. Yep. Whereas bonds don't discover gold. Bonds will not find a cure for cancer. They're a loan to that company. And will they pay you back is the risk. And how much is that loan worth? Well, how much coupon are they paying is really all it's about. So they're a lot more stable, and therefore their volatility annually is very, very low. Fixed rate bonds, 2 to 3% per annum. Floating rate bonds, 0.2% per annum, so 1/10 of that. So they don't really move at all. And that's why a lot of people see them as a lot more cash-like, in that they're not going to shoot to the moon. So if Woolworths buys a whole bunch of really interesting new businesses and its equity price shoots up,
yep,
all the bond market will say is, does that affect them paying me back? No. If it actually strengthens my position because they've got more cash coming in, they will like it. Otherwise, they will not care. And the bond price doesn't shoot up because it is not the business. The equity is the business.
Get it. So whilst the share price is moving around, the price of the bond remains relatively stable.
Yeah,
the coupon payments and the maturity payouts remain exactly the same as they are.
So when Qantas got in trouble about 6-8 months ago and its share price fell a lot very, very quickly, absolutely nothing happened to the bond, because the bond market assessed, is Qantas really in trouble, or is it just its equity has fallen because of oil prices, I think it was. And is that going to affect their cash flow? No, it's not. Then no impact on the bond.
Okay. And just at maturity, sometimes the price of the bond can run ahead of or below the $100 face value. If it's running ahead at maturity, do I only receive the face value back?
You always only receive the face value back. So all of these XTBs will mature at $100. Mm-hmm. Now, some of them have got pretty high coupons, so they're trading, you're getting that coupon. So Telstra, you're getting $7.75 per annum. Wow. We'd all love 7.5%, but it's not realistic. Yep. So you pay a higher price. That higher price will ratchet down towards $100, but you're getting that $7.75 every year, and your total return is, how much did I get from that really quite high coupon? And then, well, I'm going to have a bit of a capital loss from what I bought to the $100, but put it all together, and that is your yield to maturity.
Or I could sell and take a capital gain.
Yes. So Qantas bonds got upgraded from non-investment grade to investment grade, and their price went up.
Right.
And so people who bought here had a price rise. So sometimes people do buy and sell bonds, although we have noticed that most people are buy and hold to maturity. They're buying the sort of bigger picture of, well, I know on day zero that this yield is 3.45%, and I want to lock that in for the 3 years until that bond matures, so I know that's going to happen. And by the time I get to the end, 3.45% will be the sum of my coupons and my final payment.
Right. So a greater degree of certainty than equities, the prospect for maybe some capital appreciation as opposed to a term deposit that's always going to be face value on receipt. Among all the other things we've talked through today, is there anything else that might interest retail investors or trustees with regard how they may use an XTB?
I think what when people think about fixed income, they look at all the different range of options that they can invest in. And for quite a few years now, 5 years, we've had fixed income ETFs, and then there's fixed income that trade on the exchange, and fixed income managed funds that don't trade in the exchange, and you'd obviously have some fixed income M funds as well. There is a big difference between all of those and holding bonds individually, and the big difference is that none of those mature their perpetual trusts, whereas holding bonds individually, they will mature on a certain date, and you think, well, that's kind of obvious. But what it actually drives is that predictability, and you know $100 here, $100 here, $100 there, and all those coupons along the way. Back here on day one, I know precisely what I'm going to get if I hold bonds individually, and that predictability and stability comes from that. Whereas you put them all into a trust, whether it's an M fund, a managed fund, or an ETF, you get a different outcome. It's not to say that that's a bad outcome, it's just different because it's perpetual. So you don't know what you're going to get on the day you sell, because it's a day, when am I going to sell? I'm going to sell in 3 years. What's the price going to be? I don't know. It's going to be the price of the units. You say, well, some of those bonds are matured. No, but they will be replaced by other bonds.
They look a little different along the way.
So it's related to fixed income, managed funds and ETFs, but it's not the same as holding bonds individually. And if you're comparing TDs with the two of those, the much closer comparison is TDs with bonds, not TDs with ETFs or managed funds. It just means they're different. Right. They both have benefits and features.
Yeah, indeed. Richard, thank you. I think you've provided us with some insight today in terms of a direct investor or self-managed super fund trustee perhaps looking for a pure exposure to an Australian corporate bond, and an easy way to do it by trading and transacting through the ASX. So appreciate your time.
Thanks, Ian.